Welcome everybody. This is Mahendra Pabba. Let's start the session by looking at what is stock market. Now, before going into the stock market, let's see what market is, right? So first we'll look at the market part, then we'll come to the stock part. But the name itself suggests that market is a place where people come to buy and sell goods. Example, there is a vegetable market where all kinds of vegetables are exchanged. Similarly, stock market is a market place where we can buy and sell various kinds of securities. When I say securities, it could be shares, derivatives, debt instruments. So we'll come to in detail discuss about these different instruments. We need to understand the market part. So market is a place where people come and buy, right? So stock market is something where people buy and sell various kinds of securities. In India, we have many stock exchanges, but a couple of them are popular and most people are using these exchanges. So there are two exchanges. One is NSE, which is National Stock Exchange, and the second one is Bombay Stock Exchange. Now these stock exchanges are regulated by SEBI, which is Securities and Exchange Board of India. So the stock exchanges operate under the defined rules as stated by the regulator. The stock markets acts as a primary market and a secondary market. So there are two types of markets here, the primary market and the secondary market. As a primary market, the stock market allows companies to issue and sell their shares to the common public for the first time through the process known as IPO, that is initial public offering. We will discuss about IPOs. Now, we see a scenario here, how people run business, right? So there is a promoter who is having a company, he is running factory or company, and he has to get raw material. So he gets raw material from different vendors and he employs people. So he has to pay employee salaries. Then regular maintenance is there. So for that, he require money. That is his expenses. And what is his income is he sells those products to customer and customer pays back the money. But in the process of doing this, there is a lag here, right? The time they put the money, they purchase the raw material, and by the time the customer pays, there may be 3 months or 6 months delay is there. So the person requires the working capital to run this factory or company. So what they do, they go to bank and take loans, right? They take loan and they run their business. And as soon as the customer pays back, they will pay back their loan with interest. So the interest is the expense for him. Now, whatever profit he is getting, he is paying some part, or sometimes if the loans are big, the income is going towards the interest payment. So that is a big problem. So he has to reduce the interest part, right? And also he wants to purchase a new machinery. So he require some more funds. So instead of going to the bank where the bank accepts some security, right? So he might have already exhausted his securities for pledging, right? So or for mortgaging. So he approaches private equity investors. These private equity investors are a group of people or a company who puts investment in different companies. So he approaches a private investor and they put money. In return, he will forego his shares, some of the shares. So maybe 20% of his shares he will sell to this private equity investor. So what benefit the private equity investor will get is the increase in the valuation, right? For example, if he is investing at a rate of 100 rupees, so the private investor would like to get out or in cash maybe at 200 rupees or 300 rupees, depending upon their investment. So here he will take money, he will pay back the loans, so he does not require to pay any interest, right? And if the company is doing good, the benefit will go to him and as well as the private equity investors. But if the company is not doing good, both will be affected. Here, this is the model what people use to run the business. And I have given only a couple of like banks is one of the places where they get funds or the private equity. So if you look at what are the reasons for going for fundraising, one is reduce debt. As we have seen here, he has taken loans from the bank to run his business. And there is a huge interest component which is running, right? So he wants to reduce that. So he wants to reduce debt. So he requires funds. So you want to raise funds to reduce his debt and also monetize investment. As we said here, there is a private equity investor who has invested money and he has to monetize, right? He has invested at 100 rupees. He has to get out at 200 rupees. For that also, fundraising is required. And the basic working capital requirement is, would be there to run in the company. So that is the one more reason. And business expansion. Say a company would like to expand. So it could be he wants to extend his factory here, or maybe he wants to replicate the same factory in somewhere else, somewhere in other state. So he requires funds. And also sometimes to start a new business also he will require funds. There is nothing, no factory or no company, nothing is there. He has just an idea. Okay. So what I'll do, for example, I have an idea of starting a business. Then what I do is I approach the investors and I will explain them, okay, this is my business plan. You put money in this. So based on my investment plan, my presentation, people put money in that and I start the business. So I'm starting the business at zero. So there is nothing there, but still I can get funds by just selling my idea. So for that purpose also I require funds and to get benefits from listing. So when you are listing on stock exchanges, there are certain benefits. So like it adds prestige and importance to the company. You will say our company is listed on stock exchanges, and it also gives an exit route to investors. People who are invested, they will have an exit route when they are going for the fundraising. For example, if you are working in a company and the company allocates some shares to you, right? Then how do you monetize that? Who will purchase those shares? For suppose if the company goes for listing, then you could sell your shares. So that is the exit route for investors. And if you are a listed company, you could raise further capital from different institutions because already you are a listed company. So there is a credibility to you because when you want to list, they check so many parameters. If you're satisfying that, then only they will list your company on the exchanges. So, and also you need to follow strict guidelines when you are listed. Means every quarter you need to publish your earnings. You need to publish your balance sheet every quarter. And there are strict rules how to give information to the investors or general public. So if you are a listed company, there are a lot of advantages. So due to these multiple reasons, people go for listing in the stock exchanges. Now, when I say listing, what I mean by listing? For example, the same person has invested 100 crores in that company. So 10 crore shares are there. Each is 10 rupees worth. So it is 100 crores. Now, after some time, maybe a year, 2 years, 3 years, the company has grown and the current value is 1000 crores. So the shares would be same, right? 10,000 crore shares is there, but because the valuation of that company has increased, now the value is 100 rupees. Now he want to monetize his investment. He has invested 100 crores. Now he want to take some money and start some other business, or maybe he has already brought a private equity investor and they want to exit. So what they do is they go to the stock exchanges and list their shares so that they can raise funds. So what they do is they want to raise 200 crores. So they have to sell 2 crore shares because right now the price is at 100 rupees. So if they forego their 2 crore shares, they will get 200 crores. Now, when they are listing on stock exchanges, they have to fix a lot, right? A lot, for example, is minimum 75 shares. For this, like 7,500 So if someone wants to invest in this company, they have to uh, have 7,500 as a minimum amount. So if you have 7,500 amount, you can purchase a lot and you can get 75 shares of that company. To facilitate this process, a company needs a marketplace. Simply they cannot go to public and say, okay, you give me 7,500, I will give you so many shares. No, they cannot do that, right? So to facilitate this process, a company needs a marketplace where these shares can be sold. So now this marketplace is provided by the stock market. So basically the company will sell the 2 crore shares at a price of 100 per share and collect 200 crores worth of funds. Now, there are multiple ways of raising funds. The one what we have seen is the IPO, which is the initial public offering. So in the primary market, the new stocks are sold to the public for the first time. So investors are able to purchase securities directly from the issuer. So you are purchasing directly from the company which is issuing the shares. So IPO is when a company issues a shares of the stock to the public for the first time. That is one way of doing. The second way is rights issue. So rights issue means it's an offer to the company's current stockholders to buy additional shares at a discounted price. There are certain people who already own the shares. Now the company can issue a rights issue where the existing shareholders can purchase new shares at a discounted price. Discounted price because there are already shares which are there where the price is there where people are buying and selling. But additional funds are required by the organization. So they issue the rights. And the other is preferential allotment. So in this case, shares are offered to a particular group at a special or discounted price, different from the publicly traded shares. A preferred allotment, the company wanted some funds and somebody is interested, so you allocate to them. So that is called as preferential allotment. Similarly, private placement is also there, or QIP. So instead of issuing to public marketplace, it is issued to an individual person or a corporate entity or a small group of investors. So that is private placements. And QIP is qualified institutional placement. So the QIP allows a listed company to raise capital from domestic markets without the need to submit any filings to the government. Now in return for this savings of time and money, the funds must be raised from only registered or accredited institutions only, the two Indian institutions. So these are the different methods available for the companies to raise the funds. Now, for example, recently we have seen Zomato coming out with IPO. As we have seen this example, one of the company wanted to raise funds, so they have gone to the exchanges and they are selling this 2 crores. So what happened? Minimum we said that 75 shares one has to purchase in one lot. So what public will do is they bid. Okay, so I want to purchase 1 lot. Someone will say I want to purchase 10 lots. Someone will say I want to purchase 1,000 lots, right? Depending upon individual capacity. So general public places bids to acquire those 2 crore shares. Now you might have heard that Zomato has been oversubscribed by so much, 100 times, 200 times, like that some number they will say. Now there are multiple scenarios when people apply to get these 2 crore shares. Now if the total bids are less than number of shares offered, right? For example, here we said 2 crore shares, right? Now people based on company profile, they will place bids. Now if the total bids are less than the shares offered, then every applicant will be assigned the shares. So there is no problem. Everyone who has applied will get how many they have applied, they will get those shares. But if the total bids are greater than the number of shares offered, there are two scenarios. One is small oversubscription is there. Instead of 2 crores, 3 crores total bids were placed. So what happens is, first of all, the rule is minimum 1 lot need to be allotted to everyone. So first they will do is they will allot one lot to everyone. then the remaining will be assigned proportionally to how many you have applied. Somebody might have applied 10, so he may get 2 lots or 3 lots. Somebody who has applied only 2, he may get only 1 lot. So depending upon these oversubscription, you will get it. But sometimes there is a large oversubscription. Instead of 2 crores, sometimes, like for example, Zomato and all, 58 times it has been subscribed. Recently, one of the IPO, 196 times it has been oversubscribed. So that means for one share, 196 people are trying for it. So there is large oversubscription is there. So how the allotment will be done through lucky draw. So only one lot you will be getting, and that too with lucky draw. So whatever amount deducted from your bank, that would be reversed back to your bank account. So that is how the IPO allotment is done. Now, why would you invest in those companies? Like for example, as I said, Zomato has come with IPO. Now, you know that, okay, that company is doing good business. If I put my money, I may benefit. So what kind of benefit you are looking at? There are 3 ways you can benefit as an investor. First is listing gains. So what I mean by listing gains is, after the company has given the shares, they will list those shares, those 2 crore shares, on the stock exchanges on a particular day. For example, Clean Science is a company, a pharma company, which has come with an IPO, and it was listed on 19th, that is 3 days back. Here the issue size in crores is 1,546 crores was raised, and they have put the price of one stock is 900 rupees. At the listing, means the starting, when they have listed the price, the trades have happened at 1784. That means one person was ready to purchase this company stock at 1784 when the person who has applied for the IPO had purchased at 900 rupees only. But because there was 196% oversubscription, now people want to get hands onto this stock. So they have to buy. So they buy at whatever price they come. So at the time of listing, it was quoting at 1784, and the listing closed at 1585. That means after the allotment, that person has got 76% gain in that maybe 10 days time. From the time you put money in your application to the time you exit, there is only hardly 10 days time, right? So you have gained 76% of your investment, and the current market price is so and so. Even though the listing was at 76, after the listing it has gone up, so means maybe on 20th, right? So yesterday 20th it moved to 1736. So if you were holding that, you would have made 93%. Similarly, GR Infra also been listed on the same day. So the issue price was 837, but the listed price was 1700. So like more than double, right? So you invested some like maybe 8,000, 9,000, and you would have made 8,000 in those 10 days. So the investors put money in IPOs, that is in the primary market, for listing gains. Now, if you see a previous example of Nazara, the listing gains was only 43% compared to this. But in some other, like Kalyan Jewelers, issue was at 87 rupees, but listed at 73. So the people who have got the shares in the IPO would have lost 13%. Right now it is at 72. So overall you would have lost. So when you are investing in an IPO, you need to look at the company data, and based on your calculations, then you need to take a decision whether to go for that IPO or not. So that is one way of looking at the IPOs. The second way is rise in price. So today it might be at 75, but if you wait for a year, this could go to 150 based on its performance. So all IPOs are not about the listing gains. Some we look at the rise in prices over a period of time, maybe 1 year, 2 year, 3 year, based on the performance of the company. And the third way of looking at investing in the primary market is the dividend. You have put money in that company, so they have taken those 200 crores, and with those 200 crores, that company might have started a new factory, And after that factory is commissioned, they go to sales and they are making more profit now because they are able to sell more quantity. So they are making more profit. Now with that, more profit is generated. So what will happen? It will give the profit to the shareholders, right? So it will give dividends to the shareholders. So it will announce, okay, we have earned 500 crores. So let's give 100 crores back to the shareholders. So depending upon number of shares, right? So many shares are there. So they divide so much amount by so many shares. And each share, for example, you may get 2 rupees or 5 rupees, 10 rupees, 15 rupees, depends. So they will announce dividend and they pay the dividend. So these are the three different benefits for the investors. One is the listing gains. One is the rise in prices. So after the price is raised, you exit that stock and you make money, or you stay in that stock every year, every quarter, maybe every 6 months. They will announce dividend. You get that dividend. And one more thing is the dividend is tax free. So whatever income you get through dividend, it is tax free. And also one more point is why it is subscribed 196% and all, because people are looking for listing gains. Sometimes it may fail, but how do they do is you need to invest 7,500. So what you do, you borrow 7,500 on interest for 1 month maybe you take, because 7,500 interest you maybe even if you take a 2 or 5% also, you need to pay some amount, because when you are looking to gain like 50, 60, 80% or maybe even 40, 50% also, paying 5% would not be a big deal. So people take money and they put in the IPO, and after they get, now they have to return that money. So they exit on the first day itself, they exit because they have to pay back the money. So that's why on that day, a lot of people sell and a lot of people buy on the first day itself, because people need to pay back their money because they have borrowed and put the money in the IPO. Now, whatever we have seen is the primary market, right? So in the primary market, as an individual, if you want to put money, for you, there are only two opportunities. One is IPO. Whenever the company for the first time it comes with initial public offering, then you can put money there. Or if you are already holding a stock and if they come with the rights issue, you can put some more money and you can get back the one. Right. So all these are primary markets. As we have seen, the stock markets operates in two ways. One is primary market and the other is secondary market. So let's look at the secondary market. Now the primary market refers to the market where securities are created and issued for the first time, while the secondary market is one in which they are traded afterwards among the investors. You have applied for IPO, I have applied for IPO, both have got allocated. Now after that, I want to exit a stock. I need money, so I want to exit. So you can exit in the secondary market where the other people who want to buy that stock are there and you are selling that stock. The secondary market is what commonly known or people think as the stock market. When I say stock market, it is the secondary market.